Section 4.8, term structure of interest rates. What we're looking at in this video is how interest rates are related to each other across this term to maturity line. So that is, what is the relationship between 1-day and 30-day interest rates and the 5-year rate and the 10-year rate? Okay, and the term structure of interest rates, hopefully you've done a little bit of reading on this prior to listening to this video, but what the term structure of interest rates idea suggests is these following 3 points in comparing interest rates on loans of different maturities. So what we're doing is we're comparing say 30 and 90-day interest rates with 3-year interest rates with 10-year interest rates. We're doing a comparison of these interest rates over different durations of maturity, or just different maturities. The first thing that we'll notice when we look at interest rates is that these interest rates of different maturities tend to move together over time. Long-term yields, so what that means is that all of these interest rates and all of these different money markets are highly correlated. Okay. Number 2, long-term yields tend to be higher than short-term yields. What that means is that if the 30-day interest rate, for example, is 3%, then the 1-year rate might be, say, 3.5%. The 5-year rate might be 5%, and the 10-year rate might be 5.8%. So as you move from left to right and the term of the lending increases, then the annualized interest rate normally rises as well. There are exceptions to that, but generally, if economic conditions are stable and the economy is at full employment, then as we move from left to right and the term of the loan increases in these money markets, the annual interest rate payable on that loan should increase as well. And then the third one, yields on short-term bonds are more volatile than yields on long-term bonds. Okay, so short-term bonds, short-term debt or discount securities. This short-term bonds is American terminology. I'm just trying to get you used to different terminologies because we will be looking a lot at the US and other countries as we move forward in this unit. So short-term bonds, that just means discount securities in money markets. They are more volatile than yields on long-term bonds. So even though the 10-year interest rate, for example, might be higher than the 90-day interest rate, if you have a look at the movement of the 90-day interest rate compared with the 10-year interest rate over time, over a long period of time, say a decade, there will be larger swings in the 90-day interest rate than there is the 10-year interest rate. And there's very good reasons for that. So in summary, the term structure of interest rates tells us that all of these interest rates tend to have some degree of correlation. As we move from left to right, the annualized interest rate tends to increase. So we would expect to pay a higher annual interest rate if we want to borrow money for 10 years versus, say, 90 days. And remember, I am talking about annualized interest rates here. That is key. And then finally, we would expect greater fluctuations over, say, a 10-year period in these short-term rates than we would these longer-term 7 and 10 and 30-year rates, for example. So what we're going to do is go through each of these in more detail, because once we understand why this is true, then it really does provide insights into how global financial markets work and how the Australian economy and other economies work. So we're doing a lot of work on interest rates because interest rates affect consumption spending, they affect investment spending. They also attract money into economies. So if we need foreign money to finance our investment spending in Australia, the question is, how do we attract that money into Australia? The answer is these interest rates need to rise slightly. And as they rise relative to other interest rates in the world, that will attract more money into the Australian economy. So interest rates are incredibly important to the macroeconomy. They also dictate foreign investment flows, how much money moves in and out of countries. So that's why we need a really good understanding of them before we can really move forward with more complex issues in this course. Of course, all of these interest rates also determine the interest rates that people pay on their mortgages in Australia. And we'll be talking about that in detail as well. So how do banks set mortgage interest rates? What determines those mortgage interest rates? Many Australians just pay their mortgage, pay the interest rate. They don't know how it's really determined. So we're going to find all of that out. So what we're going to do now, though, is go back to these three features of the term structure of interest rates. When I'm talking about the term structure of interest rates, I just mean these three things. So if you hear me use the term structure of interest rates, I simply mean these three features of interest rates. So we're going to go through each of these in turn. Let's tackle the first one. So I've got this sort of color-coded here, indicating that we're dealing with the first one here. Then we go down to the second one in the next slide. That's how it works. So back to this one. Interest rates of different maturities tend to move together. Well, looking at this diagram, we can see that that is true. The correlation's not perfect, but there is correlation there, no doubt. So we've got the cash rate, 6-month bank bill rate. This is the 2-year rate on government bonds, and this is the 10-year rate on government bonds. I obtained this data from the Reserve Bank website. Okay, so we are moving from the cash rate to an interest rate payable by banks, then back to bond yields payable by the government. That doesn't matter too much, that we're switching from banks to bank interest rates to government interest rates. It really doesn't matter. We're just at the moment, we're just concerned about looking at the degree of correlation between these interest rates over time. So we've got different degrees of maturity: 1 day, 6 months, 2 years, 10 years. Once again, the correlation is not perfect. Now, whenever you see time series like this, time series data, and there is a high degree of correlation, it's always tempting to ask, which direction does the causality run in? So it could be the case that these variables are completely unrelated. These 4 interest rates are let me start again. It could be possible that these 4 interest rates are completely unrelated, and that the degree of correlation you see in this graph, while not perfect, the degree of correlation is just a matter of luck. It's possible. Highly unlikely, but it's possible. But there is some causality here. Okay, so the first causality that we want to identify is the cash rate and the 6-month rate. What I've been saying so far in this topic and the previous topic, topic 3, is that changes in the cash rate will cause changes in the 6-month interest rate almost 1-for-1. So actually, I should have put percentage, indicated that the vertical axis is a percentage number. It's not, it should be obvious, but that's one thing we will be looking at a little bit later on in this course, how to create correct graphs, or graphs that are very clear to the reader. So I should have had something on the vertical axis indicating that the variable that I'm measuring is a percentage interest rate. I know it's probably obvious, but you really need to label these things. I've just omitted that there. So we've got the cash rate, the 6-month rate. And if we come back to here, this is the 6-month rate, the 180-day rate, roughly. 6 months is roughly 180 days. And what I was indicating previously was that the 1-day market, 30-day market, 90-day market, and 180-day market, from the perspective of a lender, are substitutable markets. So if a bank has $1 billion at its disposal for 180 days, it can go into any of these markets and lend that money either once in the 180-day market, twice in the 90-day market, et cetera, et cetera. So these markets are substitutable. And so that's why we don't see the cash rate and the 6-month rate getting too far out of line. They're pretty close. There was a little bit of a gap opening up here between the cash rate and the 6-month rate, but the correlation is pretty strong. So in terms of the cash rate and the 6-month rate, remember what we're doing. We're looking at why interest rates tend to move together over time. In terms of the cash rate and the 6-month rate, changes in the cash rate are causing changes in the 6-month rate because of the substitutability of the markets. Whereas what I've said in the past is when the cash rate changes, it has minimal, if any, impact on bond yields, the 2-year rate and the 10-year rate. So the way I want you to think about this, and this is a little bit of a simplification, but it's we're making this simplification to just to keep things manageable at the moment. The way I want you to think about these interest rates is this. The 1-day interest rate, when that changes, it causes changes in all other interest rates up to about a year, because all of these money markets are substitutable. The Reserve Bank sits there, dictates to the world what the cash rate in Australia will be, what the 1-day interest rate will be, and through its control of the cash rate, all other interest rates then fall into line with changes in the cash rate. And the Reserve Bank did some research a couple of years ago and found that when the correlation between the 1-day rate and the 30-day rate was about 99%. The correlation between the 1-day rate and the 180-day rate was about 97%. So when the cash rate changes, it really does almost 1-for-1 cause similar changes in these other rates. Now that doesn't mean that the 1-day rate and the 180-day rate are the same. It means the changes are highly correlated. So clearly here, the cash rate and the 6-month rate, they're not the same value, but they move very closely over time together. So here in 2016, we can see the cash rate drop from 2% down to 1.5%, and the 6-month rate dropped from about 2.45 to about 2%. Okay, so obviously there's a bit of volatility in the series. There's no volatility in the cash rate because the central bank dictates what that interest rate will be down to 1/100%. But obviously there's going to be some volatility in the cash rate. So it's almost like we need to look at sort of maybe monthly, some sort of monthly moving average of the cash rate. Sorry, monthly moving average of the 6-month rate. And that would take a lot of the volatility out of the series for the 6-month interest rate. And then you would see a much clearer correlation between the cash rate and the 6-month rate. And we don't need to do that. We can just sort of eyeball it and sort of conclude that, yes, the cash rate and the 6-month rate are ridiculously highly correlated. And on average, they move pretty close to 1-for-1. So that's the way I want you to think about the short-term rates. The cash rate changes and the other rates just fall into line and change almost 1-for-1. That's the power the Reserve Bank has. With these longer-term interest rates, and I'm kind of deliberately omitting the 1-year interest rate because that's where the line blurs a little bit between short-term interest rates and long-term rates. So let's not worry about the 1-year interest rate. Let's consider these longer-term interest rates. So the question then becomes, will a change in the cash rate affect the 3-year rate 1-for-1? The answer is absolutely not. Won't be anywhere close to 1-for-1. In fact, changes in the cash rate, it can be argued, and it's very difficult to determine this from an economic point of view. Changes in the cash rate have very little impact whatsoever on the 3-year rate. So just for now, I want you to assume, and this is a complex area, and so we have to keep it simple and make simplifying assumptions. For now, I want you to assume that when the cash rate changes, the 1-day interest rate, it changes all of these short-term interest rates up to a year, almost 1-for-1. But when you get into these markets, These are beyond the reach of the Reserve Bank. That is, they can't affect these long-term interest rates by simply changing the cash rate. They can affect them using quantitative easing. We'll get to that later. But just ignore quantitative easing at the moment. Just imagine for now, QE doesn't exist. And that's just one of these simplifications so that we can keep moving forward with the, or simplifying assumptions so we can keep moving forward with the story. With these interest rates, the long-term debt interest rates, the bond yield interest rates, I want you to think about those as determined by the demand and supply of loanable funds. So in the case of Australia, the main driver of these long-term interest rates are the corresponding long-term interest rate in the United States. And we've seen graphs showing the correlation between 10-year bond yields in Australia and 10-year bond yields in the United States. So whereas all of these interest rates, short-term rates, are affected by the cash rate and the Reserve Bank's policy and its manipulation of the cash rate, these long-term rates, the primary driver there is going to be the corresponding interest rate in the United States. So if I asked you a question about the determinants of the 90-day interest rate, you've got to automatically think it's the cash rate which determines the 90-day interest rate. That's your framework of thought. If I asked you a question about the 10-year interest rate in Australia, it would be the demand and supply of loanable funds framework. You'd use that to explain what can move the demand and supply of curves of loanable funds left and right, and therefore what can push the interest rate, the 10-year interest rate, up and down. Okay, so here, short-term interest rates, think cash rate. Here, think the demand and supply of loanable funds framework, where you've got the demand curve for loanable funds, supply curve of loanable funds. Think that. So going back to this, we had a situation where the cash rate affects the 6-month rate almost 1-for-1, but changes in the cash rate don't really affect the 2-year rate and certainly not the 10-year rate. There's not causality running from the cash rate to these bond yields. There is causality running from the cash rate to the 6-month rate, but not the bond yields. So then the next question is, well, if changes in the cash rate cause 1-for-1 or close to 1-for-1 changes in the 6-month rate, that explains the correlation between the cash rate and the 6-month rate. So that story's finished, we get that. But if the cash rate, if changes in the cash rate don't cause corresponding changes in the 2- and 10-year rates, why are they so highly correlated? Interesting question. And the answer is this. Even though the cash rate doesn't have a causal effect on the 2- and 10-year interest rates in Australia or any other country, the cash rate and these bond interest rates are both responding to a common third factor, to a common element of the economy. Let's put it that way. They're actually both responding to business cycle fluctuations in Australia. So the cash rate is not causing changes in the 2- and 10-year yields. Instead, the cash rate and these bond yields are both responding to changes in the business cycle in Australia. They're changing independently to changes in the business cycle in Australia. Let me explain what I mean by that. You may not recall this, that doesn't matter, but when was it? Early 2019 in Australia, the Australian economy started to slow. And I remember quite clearly. I was talking to someone working in retail in early 2019, and they were saying that retail sales were really dropping off. This is prior to COVID, because COVID hit early 2020. It was kind of discovered in late 2019 in China. Then it's sort of the pandemic went global in early 2020. I'm talking early 2019. This is pre-COVID. And you can see what was happening in sort of 2019. Interest rates were dropping prior to COVID. And so I was talking to this person in retail, and they were saying that retail sales were really dropping away. The person had some sort of involvement in the Karrinyup shopping centre expansion, and she was saying that they were really finding it difficult to find tenants in the shopping centre for all of the new retail space, because companies were really reluctant to set up new shops in the redeveloped Karrinyup shopping centre. So things weren't good in 2019. And so in response to that, you can see around mid 2019, the cash rate, the yellow line, starts to fall. The cash rate started to fall from 1.5% down to 1%. So that was two separate 25 basis point cuts by the central bank in around about early to mid 2019. Now, as the cash rate was cut in response to very weak retail sales, and also automotive sales were suffering back in 2019. I think the building sector, it was reasonably strong, but not as strong as it had been in 2018, 2017. So there was a real cyclical downturn occurring at the start of 2019, moving into 2019. And then, of course, COVID hit in 2020, and then, then we went into a recession. But yeah, so what happened in 2019 was the cash rate was cut from 1.5% down to 1%. And look at what happened to the 6-month rate. The 6-month rate just dropped down to just over 1% as well, just like the cash rate did. Now, of course, yes, the cash rate was rising up above 2% just prior to this. Let's not worry about that. There's reasons for that, but we don't want to go into that yet. So the decrease in the cash rate dragged the 6-month rate down with it, because these markets are substitutable. But at the same time, the 10-year rate was falling as well. Now, I've already tried to make it super clear to you that the 10-year rate did not fall because the cash rate fell. Because the cash rate market and the 10-year market, so this one-day market and the 10-year market, those markets are not substitutable. They're too far apart for the cash rate to be able to affect or cause changes in the 10-year rate. Remember, these short-term markets are used for short-term funding, mismatches between revenue and expenditure by the government, by companies, etc. Whereas these 10-year markets, they're used to finance infrastructure spending by the government if it wants to borrow money for infrastructure spending, or investment spending, big investment projects by companies. So these markets are not substitutable. The short-term markets are substitutable, but the long-term markets aren't. Companies will tap in to these longer-term markets and borrow money here for much different reasons than they'll tap into these short-term markets and borrow money here. So they're not substitutable. So where were we? So here, I'm really trying to emphasize hard that causality does exist between the cash rate and the 6-month rate, but not between the cash rate and the 10-year rate. So as the cash rate was falling, we know why it was falling in early 2019, because the economy was going into a downturn and the central bank was cutting the cash rate to try to stimulate extra spending in the Australian economy, to try to move the economy sort of back to potential output, back to full employment. So that's why the cash rate went down. But why did the 10-year rate go down? Well, we know it wasn't because the cash rate was going down. So why did the 10-year rate go down? You have to then think demand and supply of loanable funds in the 10-year market. Think of that framework, visualize that framework in your head. You've got the demand curve for loanable funds and the supply curve of loanable funds. And what we're seeing here using actual data is this 10-year rate was really getting pushed down during 2019. Yes, it did start dropping from 2018, but looking at the data, there was a bit of a jump up in 2016. It sat at a higher level. So this first part of the drop in the 10-year rate in 2018, sort of back down to 2.5%, was probably just the reversion of, or reversal of, this jump in interest rates up here of the 10-year rate to between 2.5% and 3%. So it probably just came back down because it had been a little bit too high. So natural reversion. Then 2019 hit, and I'm talking about the drop in the red line from about 2.1, 2.2% all the way down to 1%. So why did it drop from 2.2 down to 1%? Well, think about your demand and supply curve for loanable funds. How do you get a drop in the interest rate in that market? Sorry, in that framework. There's only two ways that you can get a drop in interest rates using the demand supply curves for loanable funds. That is either an increase in the supply of loanable funds and or a decrease in the demand for loanable funds. In that framework, that'll push the interest rate down in that diagram. Okay, so what happened? Well, in early 19, retail sales were weak, consumer spending was weak, and also corporate investment was slowing as well. It's hard for companies to undertake investment spending if consumers are not buying their products. So when consumer spending tends to drop, you tend to have investment spending drop as well. So this slowdown in economic activity, which caused the cash rate to fall starting in early 2019, it was sort of a consumer-led drop in economic activity, but quickly investment spending will then weaken when consumer spending weakens. So this is, think about, we're still on the 10-year rate. We're still trying to figure out why it dropped. We know it wasn't because the cash rate dropped. It must have been because of a decrease in the supply, an increase in the supply of loanable funds in the 10-year market, and or a decrease in demand for loanable funds. Let's tackle the decrease in demand for loanable funds first. Why would there have been a decrease in the demand for loanable funds in the 10-year market? Well, companies going into this downturn in 2019, companies would have decreased their demand for loanable funds because they were reducing their investment spending. Well, that makes sense. That would shift the demand curve for loanable funds in the 10-year market to the left and help drive this interest rate down. At the same time, banks were reducing their demand for loanable funds as well. Why? Because their customers were borrowing and spending less money. Because the economy was weakening. So as you go into 2019, I've already told you there was a slowdown in retail sales. Think about what impact that has. That means people won't be spending as much money on their credit card. And they won't be taking out personal loans to finance different types of expenditure. They'll just be a little bit hesitant. And so consumer spending will drop. If consumer spending drops, it means the banks won't have to lend as much money to those consumers. So every time you put money or make a purchase on your credit card, for example, then that is a debt that you now incur. A credit card balance is a debt to you. And so the government, in effect, the banks are lending you that money. So if you have a $2,000 debt or balance on your credit card, then in effect, the bank has loaned you $2,000. So then the question is, well, where does the bank get that money from? The answer is some of that money they'll borrow in these debt markets. And so if you spend less money on your credit card or take out smaller personal loans for a holiday or whatever, or take out no personal loans where you would have otherwise, then you are borrowing less money from the bank, and the bank will then borrow less money from financial markets. So there'll be a decrease in the demand for loanable funds by your bank because you're not spending as much. So therefore they don't have to lend you as much. Therefore they can decrease their demand for loanable funds. So companies cut back their demand for loanable funds because they are spending less in terms of investment. Banks reduce their demand for loanable funds because you as a customer are not spending as much. Because banks borrow money in these markets to then lend to you. If you're not spending as much, they need to borrow less. So that explains the decrease in the demand for loanable funds. What about an increase in the supply of loanable funds? Well, as we went into this recession, what happened was as we went into 2019, not the recession, recession occurred early 2020. As we went into 2019, Australians started saving more. And so savings are one of the main sources of loanable funds. So if you save more, the supply curve of loanable funds will shift out to the right. And so let's think of another person now. This other person, they earn $2,000 a week. Prior to 2019, they were spending $1,800 a week and saving $200 a week. But then you go into 2019, they cut back their spending a little bit. They're not borrowing money, so they're not creating a demand for loanable funds through their bank. They're not borrowing money, but what they're doing is not spending their income. So they go into 2019, and rather than saving $200 a week, they now save $500 a week. Well, that extra money is going to be sitting in their bank account. What's their bank going to do with it? Well, their bank is going to try to lend that money out to earn a return on it, because they are paying this person that we're talking about interest on their additional savings. The banks will then have to lend that money out into these sorts of markets to try to earn interest themselves to cover the interest that they're paying their customers. So this person who was saving $200 a week but is now saving $500 a week, the bank takes that extra savings, tries to loan it out, and creates additional supply for loanable funds in bond and money markets. So that money will actually be loaned out right across. So some banks may take some of this additional savings and lend it for 3 years. Others may lend it for 7 years. Other banks may lend some of it for 90 days. So if you save more as we move into 2019, then all of that money will sort of be allocated across these different durations of lending. Okay, so certainly for the 10-day rate, we quite possibly could have seen over that period a greater supply of loanable funds. The problem is, as economists, the only data we get is the actual interest rate, and we can see that the 10-year rate has dropped starting early 2019 from about 2.1, 2.2% down to 1%. That's all we know. We don't actually know what the demand and supply curves looked like at that time. That's impossible. We can never find out where the demand and supply curves were. I mean, demand and supply curves are really a theoretical construct. They're just a framework that economists use to help us think about interest rate movements. The only thing we can actually see in the real world is the interest rate. So hopefully that makes sense. So the reason I'm mentioning that is because we can only see the interest rate, intuitively we know, well, because we can only see the interest rate, and we know that interest rates were declining in early 2019, I'm still talking about the 10-year interest rate. Intuitively, we know that must have been a result from either an increase in the supply of loanable funds or a decrease in the demand. But because we don't really know where the curves are, because they're just a theoretical construct in our mind, the demand and supply curves, we don't know whether it was really a large decrease in demand that drove those 10-year rates down, or a large increase in supply, or some combination of both. We just don't know. So we've just got to be able to think through. I mean, there are ways we could kind of examine other data and maybe gain some insights into whether it was an increase in supply of loanable funds or a decrease in demand of loanable funds, or some combination of both, which drove the 10-year rate down. I mean, we could look at other data and maybe guess, but it would only be a guess. We can't really tell. And so the 10-year rate fell. All we can do is kind of hypothesize that it was probably some combination of a decrease in demand for loanable funds and an increase in supply, which drove the 10-year rate down. So what I've done there is I've gone through why the cash rate fell in 2019. It was because retail sales were weak and the Reserve Bank drove the cash rate down. As the cash rate fell, in an attempt to shift the aggregate demand curve to the right in early 2019, the 6-year rate followed it down, because the cash rate and the 6-month rates are substitutable interest rates, or so they're an interest rate in substitutable money markets. But then the 10-year rate and the 2-year rate as well, because they're both bond rates, the 10-year rate fell, not because the cash rate fell, but because when an economy enters a downturn, like we were experiencing in 2019, naturally you will have a decrease in the demand for loanable funds by investors and banks, and you'll have an increase in the supply of loanable funds as people tend to save more money. So the cash rate was going down, the 10-year rate was going down, but they were both responding to a downturn in economic activity in the Australian economy. But there was no causality between the two. They were both responding to weakness in the Australian economy. The Reserve Bank drove the cash rate down, and the 10-year rate was driven down by market participants in the loanable funds market, shifting the demand and supply curve for loanable funds. Okay, so a lot of information there. Hopefully that makes sense. The second element of the term structure of interest rates topic is that long-term yields tend to have long-term yields tend to be higher than shorter-term yields. And we can kind of see that here. It's a little bit unclear, but there's a good theoretical reason for this. It's a little bit unclear here. Certainly, if we look at 2022, we can see that the cash rate is the lowest. That's a one-day interest rate. Then the 6-month interest rate and if we draw a vertical line here, maybe right at the end, or just sort of above April 2022, we draw a vertical line, we're looking at interest rates of different maturities on a given day. So right above April 2022, that little tick mark, we can see the cash rate was 0.1. We can see the 6-month rate was about 0.9. We go up, we can see the 2-year rate was about, trying to be as careful as I can, about 2.5%, and the 10-year rate was about 3.25%. That's what I would normally expect. I would expect the cash rate to have the lowest annualized interest rate, then the 6-month rate to have the next lowest, then the 2-year rate to have the next lowest, and the 10-year rate to have the highest. And in fact, if we had the 30-year interest rate on this graph, then in April 2022, it was probably up here at about 4.2%, something like that. So long-term yields tend to be higher than short-term yields. It's exactly what we're seeing there. Now we can kind of see it here in 2013, 2014, although there was a period where the 6-month rate jumped above the 2-year rate. There's a good reason for that, and the reason is markets were expecting interest rates to come down. But let's not worry about that at the moment, because if we start worrying about why the 6-month rate was above the cash rate in 2014, 2015, things are going to get out of hand and we're going to get really confused. So we can see this natural ordering of the cash rate being the lowest, the 6-month rate being the next lowest, then the 2-year rate, et cetera, et cetera. We can sort of see it here. Over this period, kind of got a little bit mixed up. The cash rate's certainly the lowest, the 10-year rate's the highest. But then the 6-month rate was very often higher than the 2-year rate. Once again, there's good reasons for that. What I pointed out previously, that under normal conditions, the cash rate's the lowest, the 2nd year is the next lowest, the 10-year is the next lowest, and the 10 is the highest. That occurs, it doesn't always occur that way, but that's the way we'd expect things to happen. That is number 2. That's what we would expect to happen under normal economic conditions. That is most of the time. This period was a little bit unusual, and these interest rates did get mixed up a little bit, so particularly the 6 and the 2-year rate. That doesn't mean that number 2 is wrong. Number 2 is normally right. It just means that over this period, because the 6-month rate was higher than the 2-year rate, it just means that temporarily number 2 didn't hold. Even though number 2 holds most of the time, temporarily it didn't. Okay, so the next thing to then figure out is, well, why is it that as the duration of lending increases, as you go from the cash rate out to 10-year rates, 30-year rates and beyond, why is it that normally, under normal economic conditions, the annualized interest rate increases? Why is that the case? We're seeing that here in 2022. Before I explain why, the answer is fairly simple. Before I explain why, I just need you to, or introduce you to the concept of a yield curve. So just imagine we've got horizontal axis, that is maturity of lending measured in the number of years. So we've kind of got the 1-day interest rate there, we've got the 1-year interest rate there, 7-year rates there, the 10-year rates out here. So the horizontal axis is very much like this line here. Okay, so we're lining up all of the interest rates from, all of the durations of lending that occur in money markets in Australia and the US. We're lining them up from shortest to longest. That's our horizontal axis here. And here we've got the yield. What it says up here is normally, as the time to maturity increases, that is, as we move from left to right along the horizontal axis, the yield goes up. Okay, it says normally, not always. So normally we would expect a yield curve like this. So don't think of this line as an arrow, think of it as a curve. So what that means is the 1-day interest rate is down here, and that's the yield. Then the 1-year interest rate is here. We go up and across, and that's the yield for the 1-year interest rate. The 10-year interest rate is here. We go up and across, and that is the 10-year interest rate. Now, so it shows the interest rate for different yields to maturity. But the key thing is we draw a yield curve for a given day. So what that means is that if that is the yield curve, this green line, if that's the yield curve today, then we can say that the 1-day interest rate So we go here, 1 day on the horizontal axis, we take it up and we go there. The yield for the 1 day rate today is 3%. The 1 year rate's about here. Let's say here. We go up and across, and that interest rate's 5%. So that's saying the yield on 1 year loans today is 5%. And then 10 years, we go up, across, and that might be 7%. That's telling us that today, if you want to borrow money for 10 years, the interest rate is 7%. Sometimes people get the interpretation of these yield curves mixed up. So this curve is showing us interest rates on a given day. Interest rates on a given day for different maturities of lending. So if you see 10 years here, that is the interest rate today if you want to borrow money for 10 years. It's not some sort of future forecast of what interest rates are going to be in 10 years' time. Okay, so hopefully that's very clear. Sometimes a yield curve can become inverted and slope downwards. Now, I'll let you read about an inverted yield curve yourself, but I just want to point out that normally these yield curves rise up like that. And rising up means that short-term rates are low, medium-term rates are higher, long-term rates are even higher still. That's exactly what we're seeing here. The cash rate in April 2022 was 0.1. The 6-month rate was even higher. So that means we've gone from the cash rate here at say 0.1 up to 6 months. So if that was 6 months there, then the 6-month rate would be here. It was about 0.9, about 1.4%. So if we plotted all of these interest rates on that day in April, we would get an upward sloping curve like that. Of course, if we plotted the interest rates for November 2016, then the yield curve would actually look quite odd. It would have all sorts of funny things happening because in November 2016, the 2-year rate was actually below the 6-month rate. So the yield curve would kind of rise, then fall, then rise back up. If we were looking at November 2016, that's a little bit odd. But of course, these are the complexities that we deal with these markets. They're not, they do strange things like this. So some days, if you plot the yield curve, it's not going to look normal. It's not going to look inverted. It's going to look pretty weird. But more often than not, the yield curve will be upward sloping. Okay, so that deals with those 3 slides. So I've explained number 1, why interest rates tend to move together, and then I have explained why annualized interest rates tend to increase as the term to maturity increases. One remaining thing that I need to do, actually explain to you why, as the term to maturity increases, why the annualized yield increases. I nearly forgot to do that. Okay, it's pretty obvious. This is a normal yield curve. This is what interest rates will look like, the green line, on most days during the year. So that means if I want to borrow money from you for 10 years, you will ask me for a higher annualized interest rate than if I want to borrow money from you for 1 year. I would be selling the bond to you, you would be buying it. I would be the borrower, you would be the lender. So why is it that if I wanted to borrow money from you for 10 years, you would ask for a higher annualized interest rate from me than if I wanted to borrow the same amount of money from you for 1 year? So it's pretty much like this. I come to you, ask you asked to borrow money from you, and I'm considering 2 loans from you, I would say to you, let's just say I want to borrow $1 million from you, and the first option I'm considering is a 10-year loan. You'd think hard and you'd say, 10 years, $1 million, I'll charge you 5% per year. Then I think about that and I say, well, okay, what about if I borrowed $1 million from you for 1 year? What is the annual interest rate that you would want? And you'd think hard and you'd say, oh, if it was only 1 year, 4%. So 10 years, you'd want 5% per year, but 1 year, 10 years, you'd want 5% per year. 1 year, you'd want 4% per year, a different annual interest rate. That indicates that the yield curve, your personal yield curve, which really isn't a thing in macroeconomics, but it is right now, is upward sloping. You want a higher annual interest rate from me if I borrow for 10 years than if I borrow for 1. That's what the yield curve is literally suggesting. So then the only other question to answer is why? Why do you want 1% more from me per year if I borrow money for 10 years relative to borrowing money for 1 year? It's simple. Over 10 years, I pose a greater risk to you. And you want to be rewarded for that greater risk in the form of a higher annual interest rate. So what form does this risk take? Let's just imagine I'm borrowing $1 million off you to expand a business. Expand a business. Let's take that example. I want to double the size of my business and try to increase revenue and profits. Now, if I borrow that money, that $1 million from you for 1 year, you get it repaid after 1 year. And there's only 12 months in which something could go wrong with my business. Because if something goes wrong and my business fails, you don't get your $1 million back, or you only get part of it back. So you've only got a 12-month risk. Whereas if you lend that money to me for 10 years, that's a 10-year period in which I could go out of business and you not get your $1 million back. Get the idea? So because there is a greater risk in the form of me going out of business that you face in lending me money for 10 years relative to only 1 year, you and market participants in these sorts of money markets will ask for a higher annual interest rate the longer the term of the loan. And that's something called the liquidity premium. So, I invite you to sort of do a little bit of reading about the liquidity premium. If you do a little bit of reading about it, it'll just reinforce what I'm saying right now. So that's why 2-year rates are typically lower than 10-year rates. Look at these bond markets. Look at the 2 and the 10. Did the 2-year rate ever rise above the 10-year rate? The answer is no. 2-year rates or 2-year 2-year loanable funds markets and 10-year loanable funds markets, they're kind of interchangeable. Both of those markets would be used to raise money to lend to bank customers by banks and to finance investment spending by companies. But over that whole 9-year period, nearly 10 years, not once did the 2-year rate rise above the 10-year rate. Why? Because if you lend someone money for 10 years versus 2 years, they are a greater risk to you, simply because of the duration of the loan. And as a lender, you want to be compensated for that greater risk incurred by the longer loan, and you'll ask for a higher annualized interest rate. And this interest rate on the vertical axis in this diagram on the left, that is the annualized interest rate. Okay, so that explains why as the term of the lending increases, the annualized interest rate also tends to increase. This is the liquidity premium. It's based upon risk. Now, one final point. Of course, sometimes you do get an inverted yield curve where short-term rates can be a little bit higher than long-term rates. But that generally occurs, an inverted curve, when an economy is going into a recession. Now, I don't want to touch on that now. I don't want to explain that now, but you certainly can do your own reading about inverted yield curves if you're interested in it. I think now you've got enough information about short and long-term interest rates and yield curves to be able to read something somewhere, whatever your favorite source of information is these days, to read about inverted yield curves, and it should start making a lot of sense. We're going to finish this topic off by looking at why yields on short-term bonds are more volatile than yields on long-term bonds. But with this one, I've got three slides. It's quite a complex one. So I'm going to record a separate video for the last 3 slides of section 4.8.